Gold is approaching a major liquidity zone, and smart money is prepping their next trap right now. My macro bias today is ultra bullish, and we're targeting a massive daily liquidity pool at 4456.75. But here's the catch. We're looking for a specific long setup below key internal liquidity first. Most retail traders are looking at the exact wrong level right now, getting baited into a false narrative. Let me show you exactly where institutions are actually targeting and why the current price action is an engineered setup designed to trigger your stop loss before the real move happens. Let's dive into this explainer and map out the institutional order flow.
So that number, 4456.75, that is our primary daily buy-side liquidity target. While our directional bias for gold is heavily bullish, hear this closely. My primary focus requires one very specific condition to materialize first. We are absolutely not buying right here. We're waiting for smart money to reveal their hand. Let's break down the market structure that's pulling price toward this massive 4456 liquidity pool.
When you analyze the H4 chart, the massive institutional displacement originating from that 4260 base is obvious. We're seeing continuous higher highs and higher lows, respecting bullish order blocks and leaving unmitigated fair value gaps in their wake. While retail traders are out there panicking over every red candle, the algorithms are in a classic draw-on liquidity expansion phase. They are rapidly repricing gold toward those previous major daily buy-side liquidity pools. The institutional footprint is crystal clear here. It's aggressive accumulation and markup. Interbank algorithms are strictly defending discount arrays on every single pullback, and that algorithmic draw is just pulling price relentlessly higher. Before we get into the deeper mechanics, let's lay out the exact parameters for today's trading plan. The macro bias is ultra bullish. The ultimate draw on liquidity is 4456.75. But here is the actionable intelligence. Our primary entry zone sits in the fair value gap down between 43.89 and 43.98. And to get there, we need an internal liquidity sweep of the 43.88 level. That's the specific outcome we're waiting for. Now, I'll explain the institutional reasoning behind why we have to wait for this exact sequence instead of just jumping in right now. Take a look at the extreme premium pricing in our current H1 dealing range. Price is sitting way up at 4418.42. We are in an extreme premium of this lower time frame range. But here's the problem. This is exactly where most traders get trapped. Buying an overextended market in a deep premium is incredibly dangerous. Yes, the market is in continuation mode, but it's highly susceptible to a deep internal retracement, a classic Judas swing. Retail sees all this bullish momentum and blindly buys the top, while smart money is quietly preparing to rebalance the range.
To understand why this algorithmic draw is so powerful, we need to connect these technicals to fundamental realities. WTI crude oil is spiking over $82 a barrel. We've got stalled US-Iran talks maintaining a high geopolitical risk premium around the Strait of Hormuz. On top of that, Fed officials like Cleveland's Beth Hammack are sounding hawkish, warning that current interest rates just aren't restrictive enough and the inflation target is at risk. High oil, geopolitical stress, and inflation fears, all of this fuels institutional gold accumulation. But remember, institutions don't buy at a premium. They use this fundamental backdrop to drive the larger trend only after they secure a deep discount.
This dynamic brilliantly illustrates the trap. On one side, you have the retail breakout trader. They see price pushing past 44.18, they read the bullish news, and they smash the buy button, throwing their stops just below the recent swing lows. On the other side, you have smart money algorithms. They see the exact same momentum, but their only objective is liquidity. They're waiting for a sweep of the internal sell-side liquidity resting down at 43.88. They want to engineer a minor high just to lure in those breakout buyers, only to aggressively sweep the price back down into a discount array. They trigger those retail stop losses to build their position before taking the asset to its true objective.
So how exactly will they engineer this volatility? Through scheduled macroeconomic events. The market is actually sending a clear warning signal via the economic calendar. We have a high-impact AUD news cluster, the cash rate and RBA statements syncing perfectly with the London session and followed by the New York overlap. Now, while AUD news affects Aussie pairs directly, this specific volatility window acts as a standard liquidity catalyst across the board, including gold. Institutions frequently use these high volatility windows to run stops right into the nearest liquidity pool. In our case, that's the sell-side liquidity below us, before they reverse it into the larger macro draw.
Dropping down to the execution battlefield on the M15, is there an actionable trade right now? Absolutely not. Let me state this clearly, no trade. Smart money confirmation has not yet appeared. Price is extended in a premium with relative equal highs sitting right overhead. If you execute here, you're literally gambling against the algorithm. We have to patiently wait for price to pull back from this extreme premium and execute a very specific 3-step confirmation sequence.
Here is the exact M15 institutional execution model we are waiting for. Step 1. We wait for the 43.88 Cell-Side Liquidity Sweep. Price has to drop to clear out those early buyers and tap into the discount fair value gap. Step 2. Once we're inside that 43.89 to 43.98 discount zone, we do not blind buy. We wait for a clear M15 market structure shift to the upside, backed by strong bullish displacement. And finally, step 3, we enter on a limit order during the retest of that newly created M15 fair value gap or bullish order block. That is how you execute in alignment with institutional order flow.
For those of you managing risk on funded accounts, here are the exact prop firm trade parameters, assuming our confirmation model triggers. The long entry zone is strictly between 43.89 and 43.98. Your stop loss goes safely below the H1 swing structure at 43.64. You should be risking a maximum of 0.5 to 1% of your equity here. We scale out systematically. You take 50% off at the recent session high of 44.18.50. You secure another 25% at 44.35, and you leave that final piece running for the major daily target at 44.56.00. This setup provides a highly favorable risk-to-reward ratio of about 1 to 2.6.
This level becomes critical, though. As professional traders, we always have to know when our narrative is wrong. Our exact invalidation level is 43.35.00. If we get an H4 candle closure below 43.35, it destroys the bullish institutional order flow. It violates the discount to raise and completely shifts the macro narrative from an aggressive markup phase into a deep structural corrective phase that'll target much lower liquidity pools. If that 43.35 level breaks, we immediately step aside and reassess the structure.
To quickly recap, our macro bias is ultra bullish targeting 44.56.75, but we are currently sitting in an extreme premium. We are waiting patiently for a liquidity sweep of 43.88, pulling down into our 43.89 to 43.98 discount fair value gap. And we are strictly waiting for an M15 market structure shift before executing any long position. If you enjoy this kind of precise institutional-grade market analysis using Smart Money Concepts, consider subscribing to ICT Market Theory. And if you'd like to trade alongside these specific setups, you can find the FXTM account link in the pinned comment below. The liquidity sweep is coming. The only question is, will your stop loss be the fuel for their move, or will you be waiting to trade alongside them? Stay disciplined and let the market come to you.